How long has it been National Wine Day? For like today?
Today.
All right. All right. Hey guys, welcome. We are here to talk today with Jo Ann Koontz, who is absolutely fabulous today, about tax deductions for realtors. If you are like me, you like money, you don't mind paying taxes, it means you made money. However, you would prefer to pay as little as possible, therefore keeping as much of your money as possible. And so today we're going to talk about a lot of those different things so that if you didn't do it in 2019, you can remember them for 2020. But otherwise, you can go back and maybe even figure out some of those receipts from 2019 that you can go and look at. But I'm going to sit up here, stop making bad jokes, and I'm going to let Jo Ann run to town. All
Perfect.
right, thanks very much.
Thank you so much. Thank you for having me. This is not always the most fun topic, admittedly, so I'm always stuck with the boring topics, and then I'm charged with the duty of trying to make them tolerable to get through. As Alex said, you are already working so hard. You're already doing the things that you need to do in your business. Most of the classes that you sit through are trying to get you to work harder. Use social media, use photography, do this, do all these ways that you can do more business. I don't need you to do any more business. I'd just like you to keep more money from the business that you're doing. One thing I can say about realtors as a general population is you guys are always on the fly. You're always on the run. And so it makes record keeping sometimes a little bit problematic. It also gives you a good excuse to be a bad record keeper. And, you know, some people joke like, oh, I have a shoebox and I give it to my CPA on when? April 14th. And then they wonder why they're, you know, paying such an outrageous amount of tax. I will say this is a business and you're doing all of the other things to run this business like a business, to really market yourself and to differentiate yourself and to do all this work. But then if you don't run it like a business on the administrative side and keep good books and keep good records, you're not going to make as much money and you're certainly going to pay more in tax than you need to, all because you're not operating like a business. Now, that runs in a couple of different veins. It runs from things that are ministerial and seem like they're not a big deal, like mileage, all the way down to how do we make decisions? How do you know if what you're doing is working? So if you are the type of person who says, you know, I sponsor this, I advertise here, my name is on Zillow, I'm here, how do you decide if you should keep doing that? Because otherwise you're just doing what you did last year. And you don't know if that's working. You don't know if that's worth the money that you've invested. If you aren't able to track and see how much business that you did or how much revenue that you earned as a result of an expense that you made, and you can't do that by what you think. Like, oh, if I had to guess, I would go back and say I probably had 5 deals as a result of that. Probably isn't going to get it done. You really need to be able to identify. And a lot of times when people ask me, well, what can I do for better tax planning? They want the list. We have a list of everything that's tax deductible if you are a realtor. No problem. The list isn't the problem. It's not that you don't know what to deduct at the end of the day. The problem is tracking and monitoring and using that information to better run the business.
I have a question.
Please.
Since we're in Florida, and by the way, when someone asks you a question, because we have the mic, if you could respond back with the question.
Okay.
Okay. So since we are in Florida, we don't have state income tax, we only have the federal taxes. So this is the same nationally.
Yes.
Correct?
This handout is under the IRS rules. Most of the states that are subject to state income tax will follow the IRS rules. So as Alex said, are these good for just realtors in Florida or not? Yes, anybody could use this list because this is exhaustive for IRS purposes. And you're going to see those deductions mirrored on the states that do assess an income tax, even though we don't have one here in Florida. So if you aren't here, you probably should be. And we'll get to that because the Florida realtors, you really need to know some of these talking points to flip it around and not just run your business. I am going to put you back to work. At the end here, I'm going to talk a little bit about the Trump tax law change that happened a couple years ago and how you can use that in your conversations with your clients that might be in transition. Getting people off the fence to say, okay, why are you still in New York getting taxed to death when you could be here not getting taxed to death? So I don't want to try to make you be a CPA. This job is not that fun, I promise. But there are some things that you can use, particularly when you're trying to overcome maybe some objections, and you'll give you some good rebuttals to use with folks who are dipping their toes in the sand when they get here on real estate. Other questions? No. So on the list of deductions themselves, the IRS rules say that any reasonable and necessary business expense can be deducted on your tax return. So that means if you find something that's outside the typical categories that are on an IRS tax return, you can still deduct those things. They just must be reasonable and they must be necessary for your business. Now, how would you define those two terms? Of course, they're very wiggly. Reasonableness, I would say, if you have kids, you're familiar with the laugh test. If you say it and they laugh, then you know it's a lie. Like, no, I didn't eat all the cookies and there's chocolate chips all over their face. That doesn't pass the laugh test. So it's the same thing in the tax world. If you were going to say what's reasonable, what's a reasonable thank you gift for someone who purchased a home? Well, if they bought a $100,000 home, it's probably not a $2,000 pair of shoes. That's probably not reasonable, right? It might be necessary. You may say, yes, I give everybody orange next home colored shoes as my thank you gift so that they continue to wear them. They may need to be more reasonable price. Marketing too. I mean, tax tidbits and now marketing. I'm gonna need a raise. So, but you need to look at that vis-a-vis the reason that you're spending the money as to whether or not it's reasonable. Necessary is, of course, a little bit broader, particularly with the real estate business, because you can justify almost anything in this line of work. So this list that I've given you is meant to be the common business deductions that we see amongst all businesses, with some specific real estate expenses peppered in here. So you'll see reference to things like lead generation. If you're paying Zillow, if you're paying Trulia, to have some of those leads come your way, those kind of fees, et cetera, that are specific, MLS fees, your membership fees for Raisem, and things like that that are specific to real estate, those are also going to be deductible. I want to harp, though, for just a second on the record keeping. Who does keep track of your mileage? 2 people. I have a client here who's not cooperating with my schedule.
But
it is inconvenient to track mileage. I understand that. But in this day and age, everyone is not too far from their smartphone. There are lots of mileage tracker apps that you can download for a small fee. And I would strongly suggest that. Mileage is a place where realtors really leave a lot of money on the table.
I will say that I did download Mile IQ, and I loved it. And then I used it religiously for 6 months and then never opened it again.
This is not the testimonial I'm looking for. I downloaded Mile IQ at the behest of my CPA. I used it religiously for 6 months and then I never opened it again. Next testimonial. Who is cooperating? So you'll save half on your tax return, and then the other half, when you complain, we'll yell at you. This is like, I went keto for 6 months and then I ate every carb in sight, right? Like,
I did that too.
Well, at least you're consistent. So consistency is key when we're avoiding IRS audits. So the reason I love the Mile IQ specifically, I get no kickback from them, this is just my personal view, is it seems to be easy user interface in terms of how it looks on your phone. But as a CPA, what I receive back in the report at the end of the year, provided that you do use it, is a really beautiful summary of exactly what you drove for business purposes. Lots of times people will say, well, I'm a realtor and I work 24/7, so all of my mileage is deductible. Insert laugh here. This fails the laugh test. If you're sitting at the IRS for an audit or an exam, the auditor doesn't really believe that you work 24/7. Now, they do believe that you go to Publix and you go to yoga or you go to church or you go to your kid's school, and those things are personal. And while you might smile and wave and try to pawn a house off on someone there, that's still not business driving, right? So we need to have some percentage that are personal miles versus business miles. The apps will allow you to enter that right along as you go. You can set in the settings how frequently you'd like to be hounded, daily, weekly, monthly, and you can summarize those trips right there. It's like a dating app. It's swipe left for business and right for personal, and you can put right in there, I was at the Smith listing, for the appraisal or whatever that will substantiate your business expense. In the event that you are subject to an IRS audit and you show up with these lovely records, guess what? Your examiner already feels better about your exam. It's kind of like grade school. Those with the good handwriting had a tendency to do better on their score. If I can read what you wrote, you're more likely to do well. You have an obligation under the IRS code to keep what are called contemporaneous records. That means you're tracking your expenses as they happen. You could, at an IRS audit, be completely disallowed to take any of your mileage expense if you have not tracked it as you've gone. So for some people, they say, well, that's fine if I get audited. I'll pull out my Outlook calendar or my Google calendar and I'll backtrack to all the places that I went. If you get a nice examiner, they might accept that, but they aren't required to. So your mileage expense could go down to zero fast. Yes?
What if you track it in like a calendar book? Like anytime I go somewhere, I'm like,
Yeah.
okay, I went here and this is how many miles it was.
She says, what if you track it in a book? If you're writing it down, that's fine. My only caveat to that is you only write down what you think is going to be business. And in this business, you are on the fly. So you may be going to yoga and you get a sign call. So you stop yoga and you go show a house. You weren't expecting that. You may not have written that down in the book. So it's easier to lose out on some truly deductible mileage. The other nice thing about things like Mile IQ is you can save your broker's office, your favorite closing agent, your local board of realtors. If there are places that you go for business frequently, you can save those so you weren't telling it every single time, hey, I'm back at the office for a seminar.
Yeah, Mile IQ actually, it knows because of your GPS where you're going around to, and it'll mark your trips. It'll say they stopped here for a period of time, so that must have been the end of the trip. They started here and they went at a high rate of speed somewhere else, so they obviously got in their car, right? Like,
It's not judging your speed.
what it ended up for me is that I would be waiting, I would get to an appointment 5 or 10 minutes early. I would open the Mile IQ app, then it's swipe right, swipe left is all it is. It says you went to this trip from here to here, and it's on a map. It says here was your start, here was your finish. Swipe right, that was business. Swipe left, it was personal. And it was very easy to do that.
So easy, I stopped.
It was.
Again, ringing endorsement. Thank you. Thank you.
To and from home doesn't count.
To and from home doesn't count in terms of your daily commute, but if you do not office, then in your home office is your true office. We'll talk a little bit more about that in just a second. Then coming to the office for a seminar or, going to the board for education or something like that would be deductible from your home. It depends where your business location is. So for people who you're supposed to have no ability to office in order to take home office deduction. So if you have a space available at some brokerages, you pay a desk fee and there's a place for you. It may be a bullpen area, it may not be an office with a door, but you have space where you could work. By rights under the IRS code, you're not allowed to take the home office deduction. If that's your office, then anytime you left from home to go somewhere, you should take off the difference between home and the office. So for example, if you live 1 mile from the office, every trip that you start from home, you should deduct 1 mile from. That's not something that they hotly enforce, but that is the letter of the law.
Now, what if you have an hourly, because I have an hourly position here,
Mm-hmm.
so I drive back and forth, so I couldn't deduct that.
So if you're an hourly employee and you're not working under the 1099 rules like most realtors are,
But I also have a 1099 for a realtor too.
so you would deduct whatever mileage you're driving as a realtor for business, but if you are driving miles as an employee and those miles are not reimbursed by the company, then there's a separate part of your tax return where you would put unreimbursed employee business expense. So mileage that you drive for the firm that is not in pursuit of your own commissions, that you would say, okay, if Alex said, hey, run an errand for me, that is employee miles different than realtor miles.
That's non-reimbursable.
Uh-oh.
No, I'm just kidding.
I'm out of that one. If you're being reimbursed for those miles, they don't go on your tax return anyways because you've been compensated for them. Other questions? Happy? Confused? Silent. That's not good. Silence is deadly. So other categories I want to talk about after mileage are advertising. Advertising has a tendency to be a category that can get realtors into trouble. By trouble, I mean can subject you to an IRS exam unknowingly. An exam is the IRS speak for an audit. Advertising becomes kind of a catch-all category for you because your business is so promotional in nature. Everything you do is really to get your name out there. So you can end up with a really big advertising category as a percentage of your total revenue, more so than other businesses, right? And when the IRS uses the computer algorithm or formula to determine which tax returns they're going to audit, they're looking at you as an average at your income level on every line item of your tax return. So let's say you make $100,000. This formula will look at you. The average person who makes $100,000 gave X in charitable contributions, paid Y in home mortgage interest, clear down to the business return. These businesses would typically have this in advertising, this in rent, this in utilities, this in payroll, and they look at how much do you look like the average. not exact dollars, but how much are you following that kind of average line? The more outliers that you have where you're way different from the average line, the more likely you are to be selected for an exam. The reason being is the IRS is saying, okay, what happened here? What's different here? So if you, for example, have way more home mortgage interest than people at your income level, maybe you make cash that you weren't reporting, So that's what they're doing, is they're trying to say, hey, if the average person spends this and you're spending so much more, maybe you have sources of income you haven't divulged. If your advertising is so much higher, maybe you have personal expenses in there. Maybe you really do have more revenue that you're not providing to the IRS. So that's why they look at the relationship, not only to the number itself compared to last year, but that number compared to your revenue. If your advertising went up and your revenue went up, that makes sense. You sold more because you got your name out there more. But if your advertising keeps creeping and your revenue is staying still, then there's no magic, oh, don't do this. Some people will say, oh, 3 years in a row, you can have a loss. All those things are old wives' tales. They're not really set in stone. But these algorithms are what the IRS is using for the most part to select the IRS on the exams, the returns that they're going to examine. So that's why you have to be careful, because it's not a person thinking, it's a computer. It's a computer going, that looks weird. And when a computer thinks, it doesn't think with any flexibility. It just fits inside the box. You know how well fitting inside the box goes with everything else in life, like qualifying your buyers. So just be mindful of those things. I'm not suggesting that anything you would otherwise put in advertising you shouldn't deduct. I'm suggesting that you should consider using the other line item on every tax return, whether you're on Schedule C or whether you're using the S Corporation tax return form. You've got a line item at the end after all of the standard deductions like advertising and postage and rent, all of the things that they customarily expect to see in a business. The last line item in both of those returns says other. And you can use 5 million line items to specifically describe what you are lumping into other. So I would encourage realtors to use this line item and put as many on there as you possibly can. A, for consistency. B, for decision-making purposes. C, to keep advertising down. Because what happens? Where do you put open house meals? You go to Publix and you buy food to set out at the open house. Where would you put that? Would you put that in marketing or promotion or food? You don't want to put it in meals because then it'll only be 50% deductible and it's not really a meal. So a lot of times things like that end up in advertising. Well, that's not really advertising. Think of advertising like 1982 style. You bought a billboard, you bought a newspaper ad, print advertising, old school advertising. That's what I want to see in advertising. But for example, the open house meals, I literally make a line item under other that says open house meals, open house expense. And anything that you spent to have those open houses, again, keeps it out of advertising so that number doesn't get real big and interesting for the IRS to look at. But more importantly, if we get back to the concept of running this business like a business, you want to know where you spent the money, but more importantly, you want to know why. So if open house meals are going up, is that a good thing or a bad thing? Is it good? I don't know. I don't know. What kind of business did we get from open house? So to take it out of something so close to home, so that it's easier to be judgy about it. What about travel? Travel for, say, a manufacturing company. Is that a good expense to have more of or bad? Depends. Why are we traveling? Are we traveling for sales? Are we traveling to install machinery at a customer who paid for it? Or are we traveling because there's a problem and you have to fix it? I don't want to see travel going up if it's problem fixing, but I do want to see travel going up if it's more sales. So you can't even take necessarily just the line item and make the decision, because that's what you spent. You're also going to want to know why you spent it. And this is something that I absolutely harp on, because you can't do that if your expenses are sitting in a shoebox. You can't decide if you should. Maybe you shouldn't spend your time holding open houses because you're not really getting anything from it. And all of this needs to be with a data set that's substantial enough to make a decision. You can't have one and go, well, that didn't work, so I'm out of here. But you can say over some time and over a certain number of experiences with whatever it is that you're experimenting with, do I want to do more of this or not? You may say, you know what, I'm not going to not do open houses, but I'm not going to, volunteer to fill in for other agents because it's not proving fruitful to me or whatever. Same thing with Zillow. Same thing with anything you can think of. Why are you spending and are you getting back what you expected? Because that category in and of itself isn't going to cut it for you. It's not going to tell you enough about what you spent. It's just history. That's Katie Couric with the news. Here's what happened. That's not helpful. And it's really not helpful if it's in a shoebox. So it sounds cool, like, oh, my stuff's in a heap and I drop it on the CPA and it's his problem. It is, except you purport to be running a business. And do you think Google does that? Do you think Google's like, whatever, we spent and we'll see where the chips fall? No. You know, so that's what you want to model yourself after, is how can I effectively run this business like a business person so that I can make good business decisions? It's critical. Questions on that? The next category of problems are meals and entertainment. Meals are 50% deductible. You put 100% of what you spent at a restaurant on your tax return, and on the return it deducts the 50% that's not deductible. That's the half that allegedly you're eating.
Is that because you're not paying for yourself? I heard that you can't deduct meals that you're buying for yourself. You can only deduct for the people that you're paying for.
That's essentially how it comes down. So instead of literally divvying up each bill and saying, well, this part was mine and this part was the customer's, you submit all of the expenses, and then on the return level, half is just whacked off.
All right. So a lot of the time, I'll buy lunch for our office.
Yes.
All right. So as I'm buying lunch for the office, is that still at a 50% level? Is that a separate thing?
So I would have a line item in other called staff meals.
Okay.
And that would not be subject to the 50% because you're not going to the restaurant. You know, if you're having a party, like our Christmas party, that is in a line item on the return that is, you know, staff function.
Okay.
And that is fully deductible then.
Tacos today. Tuesday.
Yay.
It is Taco Tuesday.
It is Taco Tuesday. As a result of the Trump Tax Law Act, one of the things that changed is entertainment as a deductible expense has gone away. So I always joke with people, if we're going to take them to an event like a Rays game, for example, you need to put a hot dog in their hand because the food is still deductible. But the ticket to get in is not deductible. You need to be on the lookout because a lot of the sports teams and arts in our area, arts are huge. They don't want to lose out on all those corporate clients that they had that were buying tickets. And so what is still deductible are sponsorships. So you will find that what they formerly called, like at the Rays, they had like a 6-game season pass that was, you know, a small, so you didn't have to die at 180 baseball games. If you could get through that much baseball. I mean, I like baseball, but not that much. So if you wanted to buy a smaller set of a season pass, in days gone by, you just bought those tickets and you justified who you took to the games and why you had these tickets, and that was fine. Now the tickets themselves are not deductible, but what you'll find are some of these organizations are now offering corporate sponsorships. So you will sponsor, your name is on like one part of the toilet paper, tiny print, but in exchange for your sponsorship, you get 6 games of tickets. So it's been reworded to fit back into the IRS code. As helpful as that might be. Other questions on what's deductible?
Like personal grooming, because we have to look a certain way.
Grooming, don't touch. The airline industry made a mess out of that for you, so you can thank them. The physicians are why you can't deduct home office, because everybody went home to chart and then wrote off their big baller house. So no, the airline stewardesses are required to wear a certain type of makeup, a certain color of lipstick, and even for them, those things are not deductible. So stay away from any personal grooming, dry cleaning. If you buy a shirt with the logo on it, maybe it really needs to have a business purpose. That is a category that was hotly audited for a while. It's not so much on the radar right now, but the letter of the law is stay away from those kinds of things.
Car detailing, because we've got clients around.
Car detailing, I would say if you are driving a lot of business miles like realtors typically are, I say typically because we've got some folks out on Siesta Key that only sell Siesta Key and they're running around on a golf cart 5,000 miles a year. That's not the average realtor. So I would say yes, if you had car detailing, I would feel like that is a reasonable business expense. Back to the car for 1 second, because this is usually something that comes up, is people will say, should I lease or buy? Should I put the car in the business's name or in my personal name? Those are very personal decisions. At this point, there's no rule of thumb. This is what typically we see on the tax return. After the tax law changes, the way in which you expense the car is drastically different, and the limitations and phase outs at the different income levels are different. So I might tell you to lease and tell you to buy. So you can't say, oh, try this first. It used to be lease if you could and then be stuck buying if you had to. It's not that way anymore. Should the car be in the name of the business or should it be in your individual name? I would submit to you that that really depends on a couple of things. If you said, hey, I have a large family, so I have a giant school bus to get around in, and I have a two-seater convertible to show property because that's more reasonable than my regular car. Usually I use the reverse, but usually it's like you have an SUV to take people around and you have the two-seater for your personal self. Whatever your case is, if you've got a car that you drive for personal use and you have a separate vehicle, not just your spouse's vehicle, but a separate vehicle that you use strictly for business, then that is fine for it to be in the business's name. Think about a construction company. If they have a dump truck, the dump truck doesn't go in the owner's name. The dump truck is clearly for the business of the construction company. It's a little less clear because you're driving a car with people that you could drive personally or for business. Second consideration I would put into place is your car insurance policy. A lot of car insurance companies, when they find that they're insuring a car titled to a business, they will put you in what they call a fleet policy, where they're contemplating that lots of people could be driving it. You might see a premium increase on that policy of up to double. So that is a consideration. The other consideration when it comes to car insurance is the personal policies have a tendency to have a little bit more coverage for unexpected items like rental car if there's damage and things like that, that corporate policies have a tendency not to have. So I would shop first on the insurance and see what coverage are you getting. If you are the type of person who says, you know, I want to use Geico because in 15 minutes or less I can have insurance. Insurance is an assessment of the risk that you have for your whole life. Rushing through that in 15 minutes is not a good plan. I'm not saying their insurance isn't good. I'm saying the mindset and the approach of this is not an annoying fly at a picnic that you're trying to shoo away. This is covering all of your liability. I would not rush through that, particularly if you have rental properties or, you know, investment accounts or would like to eventually have one and not have a judgment. So it's easy for people to go, well, I'm broke, so I don't care. Well, that's even more concern. So you just need to be mindful of what those insurance policies will look like. That would be a big determining factor in addition to the business use of that vehicle. Anything else on cars?
I noticed you said lease payments on here for car and truck, but if you purchase...
So there's lease payments are listed on here, and the car expensing, there are two ways in which you can track your car expenses. There's actual, and then there's mileage. So under the actual, you would take parts of the payment and some depreciation if you bought it rather than the lease payment. You would be taking the cost of the insurance. You would be taking the cost of the gasoline, repairs, oil changes, tire changes, etc. All of those things times whatever your business percentage of use of that vehicle is. So let's say it's 80%. You'd take all of your expenses times 80%, and that's what you would deduct on the return. The alternative is to take mileage using Mile IQ and say, well, I drove 32,503 business miles this year times 59 cents or whatever the mileage is rate for that year. That typically, if you're driving a newer car, will yield you a bigger deduction. That 59 cents isn't what it actually costs you to drive per mile. It's contemplating things like oil changes and repairs and tires and things like that, and insurance. So you customarily will come out ahead if you do the mileage. However, it feels really good to put the credit card in the gas pump that goes back to the business. People just feel like they're kind of winning, like they're getting one over on the government. You can't put the credit card in and take the mileage. You can't pay for the actual expense of the gasoline and take the mileage on Mile IQ. Do you see the difference? Yes?
Yes.
Okay. It's one or the other, and you have to put in place one of those methods when you put the car in service. In service is the IRS lingo. Once you start to use that car for business, you're stuck with actual versus mileage then for the lifetime that you have that car placed in service in that business. You can't flip-flop every year on the same vehicle. You get a new vehicle, then you can say, I want out of actual and into mileage, or vice versa. You do that when you place a new car in service.
So you would suggest doing mileage over actual?
I love mileage unless you've got a really old car that does require a lot of repairs, or you've got a really fancy car, like if you have a Lamborghini and you have to change the clutch every 10,000 miles, something that's really going to have a lot of expense to it. Even though it's not older, Those kind of things are where I would look at doing actual versus the mileage. If you have a regular run-of-the-mill production car that was not handmade, that's not 20 years old, I would probably stick to the mileage. And I would stick to it. Don't do 6 months and then quit. Sometimes people say, I'm not judging, I promise. It might feel like it, but I'm not. What some people will do is say, well, I drove 35,000 miles this year, and I'm gonna say 90% were for business. That's fine. That does not work at all. That does not pass the laugh test on an audit at all.
I'm a new realtor, so my question would be, how much money does that make a difference when you're doing taxes? Like for mileage?
So the mileage, every mile that you drive is, for example, say 59 cents.
Okay.
And then, that goes on the business tax return to reduce your income.
It's
So,
always 59 cents.
no, it changes every year. It might be 58 and a half. It goes up and down.
it's
Some years
in that range.
it's all in around that range. Yeah. It's been 56 and a half, but it's not like it goes to $1.50 and then back. But it all fluctuates in that 50-ish cents per mile range. So depending on the number of miles that you drive, that becomes a deduction off of your income right off the top. So it reduces the income that you've earned, and which gives you a lower profit, which is what you're taxed on at your ordinary income rate. Ordinary income rate means the tax brackets that you're accustomed to people hearing. So am I in the 20% tax bracket? That's what ordinary income rate means. Whatever normal bracket you would fall on. That's how your real estate income will be taxed. Whether you're on Schedule C or have an S corporation return, which I think is going to be beyond the scope of today's talk. But if you have questions about that, we certainly can do that offline.
I do want to talk about that.
Okay.
And as a testimonial.
Okay.
When we get there.
Now, and one he followed through on. Yay! A keto we stuck with. So you've got the list of tax deductions. If there are questions about that, let me know. One thing I want to hit on real quick, I don't know how I'm doing on time.
You're doing great.
Okay. One thing I'd like to hit on real quick are the changes that happened during the Trump Tax Law Act. Now, that feels like it was a long time ago, but last year, your 2018 tax return was the first year that you got to see that in play. So the law changed, and then boom, we had a tax return. People are still trying to figure out how did that affect them. The other thing that happened is the rules changed right around Christmas time that year, and so the only people who read it were people like me. So you went the whole rest of the year and didn't worry about it until it was time to come do tax planning. So that's not the best strategy, because you can't really go back and change what you did throughout the year to maximize things. Like, for example, with the entertainment. If you didn't know that entertainment was no longer deductible and you continued to buy tickets for everything, you're going to be disappointed the following year when you see your tax preparer and they said, well, you should have called me and I would have told you. So don't avoid your tax preparer. You should be having conversation with them. Again, how often do you think Google does tax planning? It's not on April 14th. And I'm not suggesting that you need to do everything they're doing, but look at whatever company that you find successful and see how those owners are behaving. And you can't be so busy in the business that you're not working on the business. And that comes not only from marketing, but also from the operations of the business. Don't work this hard and then throw your money away. You might as well be at the beach. If something is going to be free, you might as well be at the beach, not working. So I've got a list of changes that I can provide to you as well. This is not only things that will affect you personally, but this is talking points for the Florida realtors to keep in mind as you are having conversations with people. I'm not telling you to give them tax advice. I'm saying to have a jaunty debate about whether you should continue to live in New York or Connecticut or Illinois or whatever state is currently robbing you from high tax rate, right? So some things that changed, we kept 7 tax brackets when that rule changed. They were talking about simplifying our structure, which is what every politician says, but that no one is actually versed in tax, so you don't know what that means. And the IRS code is really complex, and definitions of what is a family or a related party aren't even consistent from different sections of the Internal Revenue Code, let alone once you dive into the business sections. So simplifying the code. Go to flat tax. I promise I'll never be out of a job. Like this is not simplifiable. It's been done in such piecemeal. We still have 7 tax brackets. They talked about going down to 3. There's still 7, but the top tax bracket was lowered from 39 to 37%. What really happened that made a big impact for people is the brackets changed the floor. So how much money you could make and still be in a lower bracket went up. So that 39% bracket, not only did they save 2%, but it was a higher amount of money to earn before you got to the top tax bracket, so that was a bigger spread of what they saved, not just 2%, because they could make more money and still be in the second highest tax bracket, for example. And that went all the way down to the bottom. Before you get to the second tax bracket from the bottom, you could make more money. So that part freed up some income for folks. But long-term capital gains stayed the same. Standard deduction doubled. So you're going to hear some people in the real estate business saying, why bother? Interest is no longer deductible for me, because home mortgage interest and real estate taxes were in that lump of category of what was itemized versus standard deduction. So this code said, you know what, we're going to give everybody a double standard deduction so you don't have to worry so much. This was really to try to help people that are renting. They don't have mortgage interest and real estate taxes to deduct, so they got to jump up to save some money because they got a higher standard deduction. So in the first-time homebuyer category, this may have less impact. Know that when you're talking. You don't necessarily have to tell them that, but understand that in the background. Home mortgage interest used to be deductible up to $1 million. It's been reduced to $750,000. Again, not your problem, just so that you know. But the 121 gain exclusion still applies. 121 is the sale of a primary residence that was your primary residence 2 out of the last 5 years. Don't confuse it with homestead for my people in Florida. Primary residence to the IRS does not equal homestead to Florida. They're different rules. It sounds the same. You think of it the same because it's all where somebody lives, right? This is the places. Yes, thank you.
Yes.
Emphatically, yes. The problem is under the IRS code, it doesn't have to be homestead. It has to have been your primary residence 2 out of the last 5 years. Why do you care?
Okay.
You should care on helping motivate some people into putting a sign in the yard to sell it. Mm-hmm. It could be the difference between that sale being completely exempt from tax and being taxable at long-term capital gain rate. Why do I mean that? Why would that happen? Let's say it was my primary residence in 2014 and 15, but I started renting it 16, 17, 18. When do I need to sell that property? Well, if I sell it if I lived in it in 14 and 15, and I sell in, say, 17, it was a rental in 15, 16, 17. Now you can go back and say, well, it was still my primary residence for those 2 years. 2 years in the 5-year window. $250,000 for a single person, $500,000 for a married filing joint couple. If you need to kick them over the fence and say, hey, come 2021, you're going to fall out of that 5-year window, this sale of this property will be taxed. So for your people that are holding on, trying to catch the top of the market, got to be careful. Do I expect you to run the calculation? No, but you can use that to nudge them and say, you ought to talk to your tax person. Because, you might be trying to sell the house for $25,000 more, but if you go from 0 tax to 15% tax on the gain, that could wipe out and more what they were trying to sell it for.
Absolutely. You brought up a point earlier, and I'm going to try to talk loudly so your mic picks it up. Actually, it kind of looks like it is. So, specifically, you mentioned about tax deductions for property and for income coming off of the federal returns. And I'll tell you guys that tax migration is very real, and it is absolutely happening. In most states, I don't know the exact number, but most states in the country do take income tax, where we don't in Florida. In fact, it's constitutionally, we don't have an income tax here, and we don't need it because we have so many visitors. But if you're talking to somebody who's coming from New York, if you're talking to somebody who's coming from California, they are fleeing those states and coming to states like this. Donald Trump did it. He left New York and now has Mar-a-Lago as his residence, right? That is his primary residence. And, part of it's the climate and part of it's also the financial climate, because it just makes a lot more sense to do that. And so if you're out talking to people who live in those states, that might not be part of their jargon. It might not be a part of their conversation. But if you make it a part of the conversation, just say, hey, listen, if you come over here, just talk with your accountant, but see what that difference really looks like for you. It really might make a big difference when they come in.
It might change whether they buy now or whether they buy a small beach condo because they're only going to spend a couple weeks out of the year here versus Now, it might change the price point. Now I need something that my family can live in, because you're right, I didn't think about that. It's going to depend on a lot of factors, what kind of businesses they have, what kind of rental properties they have, what do they have going on up north.
Way outside our scope.
Way beyond your scope, but it's certainly worth, kicking the can around to have the conversation. If you are reading in the news or you have a particularly sophisticated client that's keeping up with this particular issue is called the SALT deduction. It's state and local tax deduction. So what used to happen for our friends in New York, and I'm a Giants fan, so we'll pick on them, is on their itemized deductions on Schedule A of their 1040, they got not only mortgage interest and real estate taxes, but they also got to deduct their state income tax. We deduct sales tax here because we don't have a state income tax. So they got whatever they paid in real estate taxes in their home state, plus whatever they paid on their state income tax return the prior year, off as a deduction. That is now capped at $10,000 for everybody. Think about a high income earner coming from New York. They might have had, our equivalent here of $40,000 in real estate taxes is a house that's about $3,000 in real estate taxes. They're paying $40,000. So right away, in a regular average working home, you've got people who now can deduct $10,000 of the $40,000 that they were paying in real estate taxes. They also pay income tax on whatever they're earning. That could be $10,000, $15,000, $30,000, $50,000, $80,000 in state income tax. So that used to be a $100,000 deduction. It's now $10,000. So now they're out that money every year that they used to be able to take off of the tax return that they're now spending on tax. That is a huge motivator. Tax migration is what that concept is called when people are moving specifically to run away from the tax scene at home. And it is California, it is New York, but it's also places like Michigan and Wisconsin and Illinois is a big one. We get a ton of people from Illinois. So when you see that, it's not your job to do the tax planning, but when you're pointing out how great it is here, you want to keep reinforcing those things. You're either going to confirm that they are going to buy, or you might have an opportunity to adjust their sales parameters. And maybe they are going to buy something for the family and be here full time and spend a little bit more. Or maybe they're going to buy something now and something later. So anyway, having that awareness where you're not just in your box, you're not giving advice you don't need to be giving, but you are aware of this kind of issue is a big newsworthy issue. You appear to be a more trusted professional who's not just looking at this deal like a suitcase, trying to step on it and get it closed. Don't just worry about your deal, but you're looking out for this person's kind of overall well-being. Those things go miles. So when you're talking about converting somebody who maybe wasn't going to sell their house and they didn't realize that, oh yeah, you don't need to calculate the 2 out of the last 5 years period for them, but don't just turn away and say, oh, well, they've decided to rent it, so that's not going to apply. Yeah, they don't realize that. That's what they think. Oh, it's a rental property now, it's not going to apply. It's the IRS rules. Of course, your primary residence doesn't necessarily have to be where you live. None of these rules make any sense. Which is why I caution you against equating it to homestead, because homestead is where you live now. It's not where you lived 2 years ago, right? Okay. Other changes, seat licensing, college games like the Seminoles. Yes. Those licenses are no longer deductible. So again, if you're using those kind of things for planning purposes, for entertainment purposes, you need to be mindful that those are no longer deductible. Other questions? Questions on what is deductible? Questions on where we should be putting things on the return?
Cell phone service?
Cell phones, the IRS has rolled over and said 100% deductible. So even if you have a package plan at home that's TV and internet and your cell phone, the IRS has finally said it's a de minimis amount. It's so small. And to try to parcel out what part of your cell phone is personal versus business, that's one thing they have just rolled over on and said, have at it, Verizon.
What if you're with your spouse?
If you're with your spouse, you technically should take that piece off. Again, it's not, technically you should take that off. It's not a super hotly audited category at this point.
And if it's in your spouse's name?
If it's in your spouse's name, it doesn't matter who, it just matters that you are contributing towards it. So if you have a joint account or something like that. For the spouses who have their own like square up system, like you pay me your allocation at the end of the month, it needs to be in there.
Well, you can follow up with that because it's completely different. different?
The internet at home.
Same thing, and especially if it's a bundle package. But if it's internet at home is separate, it's still deductible.
On the capital gain tax matter, because I just did a class on it, funny enough, so it was just kind of relevant. But isn't there a law after like 2009, even if they do stay in the residence after 2 years of the 5 years, don't they still have to pay something or no?
No. There was a talk at one point when the Obamacare went into place about a sales tax on property that's 3.8% net investment income tax. That was going to get lumped in with property and it didn't. So that tax still does apply to certain types of income, but it's not on the sale of the home.
I just became an LLC. Is there a list somewhere, like besides mileage and keeping track of your expenses, things that we should be doing to get ready for our quarterly payments that we're going to owe?
Well, as an LLC, what you're able to do is tax yourself as an S corporation, which, do you know what that does for you? Saves you the self-employment tax. Self-employment tax is 15.3% of your income. That's the tax rate. So 15.3% of your profit is going to no longer be charged to you by virtue of being an S corporation.
It's a 15% rate you gave yourself.
It's huge. And what cracks me up is I do these classes all the time. If you're like, I don't know, it sounds like a lot of work, I'm not going to do that. Or I'll do it when I get busy, I'm new, so I'm not going to get involved. And then you get busy and then nobody wants to talk to me because it's tax and it's boring and you're busy. The problem is then you overpay, and you overpay for some period of time until you get tired of it, and then you finally ask, and then you go, oh yeah, I heard about that, but I just never did it. I taught this exact session at the Florida Realtors in August a few years ago, and I had a brand new agent. He was like, look, I don't know, I can't do that yet. You know, I'm new, I need to pay rent. And then he was on both sides of an $8 million transaction with no LLC and no S corporation, and I was like, I didn't even close it, so I couldn't even stop you from making that mistake. But the problem is you can't backdate that. You've got to have your LLC in place. You've got to have your license in the name of the LLC. You physically, for the Florida people, you do an RE16 with FREC, and you move your license into the name of the company. You give a W-9 to your broker so that they know to pay you, so that they aren't paying someone who's unlicensed.
Can I just stop right
Jump
there?
in.
It is the biggest pain in the butt to do it if you do it incorrectly. It is a giant pain in the butt. I have been through it several times. I've had several realtors do it incorrectly, thinking that they were just complying, doing everything in their best, trying to do it correctly, and just weren't able to hit it. Definitely, you want to make sure you're hitting the rules. If you're considering it, come talk to me first. I'm going to tell you to go talk to Jo Ann first. Is exactly what I'm going to do. But I'll make sure that you don't step on some of these classic landmines. Yeah. But when we started our company, we tried to do that on ourselves, thinking that we could go do it. And it was, I won't even use the word because we're recording. It was terrible. But when we did another company that we started after that, we used Jo Ann, and it was like much easier.
It's so much less stressful.
So much less stressful, and it worked.
Starting your own LLC is my for sale by owner. Like they think it's going to be cheap and easy, and it doesn't look that hard. And you just put it online, and I'll pay somebody $500 to throw me in the MLS, and they have no idea about coordinating inspections and appraisals and all the other things that aren't driving somebody in a car when people are annoyed. Like you get all this commission, and all you did was show 2 houses, and I found it online anyways, and blah. That is LLC formation DIY. There's a reason that DIY is on house repair and not legal documents, because you wouldn't want to watch it. There's no channel to go watch people make this disaster. And it is disastrous. It can put you out of business. It can put you on a freeze. It can cost you more money. Worst of all, you think you have protection from liability and tax, and you find out at the end of the year that you don't. What cracks me up is people will sleep in a parking lot at Best Buy to save 15% on a TV on Black Friday. And they don't save 15% on all of the profit for the whole year. And you don't have to sleep anywhere. You didn't sleep in my parking lot.
I did not. Not that time.
I mean, some people do sleep in our parking lot if you know the location, but...
Is it too late to set an LLC up for this?
No, it's not too late. Some people will say, should I wait till the end of the year, or the end of the month, or the end of the quarter? The only reason to wait to do that is to pay more and know you're paying more. What happens to some people is oh, I didn't know this cost more. That's fine. What you don't want to do is knowingly continue to pay more.
Yeah. What about... I was going to say, Megan, if you wanted to go do that and have that ready to go, it won't affect any past commissions, but
Correct.
it will go from immediately from the day that it's completed
Yep.
forward. And it's 2 separate tax returns that year, right?
What it is it's 2 separate schedules. Yeah, you're going to have your Schedule C for the commission that you earned in your individual name and your social security number. And then you're going to have a S Corp return for the commissions that you earned once you became an LLC or a PA going forward through the end of the year. So there will, no matter when you do it, there will be 1 year where you've got 2 different returns. What you do want to be mindful of, like he said, is you can't backdate any of this. So sometimes people will say, well, I've got a big closing coming, so I need to hurry up. Well, FREC doesn't have an expedite on this. All I can do to speed this up is FedEx your application to them so it gets there the next day to sit in a pile for somebody to get to it when they feel like it. It takes the SunBiz, the Division of Corporations, about a week to input and recognize the formation of the company. And then it takes FREC or DBEP, the Department of Business and Professional Regulation, it takes them about 2.5 weeks to actually convert your license over. You will receive a new license in the mail, same number, but new name. It's kind of like when a lady gets married, right? It's the exact same license number, but you will see instead of Jo Ann Koontz, Realtor, it will say Jo Ann Koontz, PLLC.
What about the difference between an LLC and a corporation, especially if it's like 2 individuals or more?
First of all, no 2 people. Can't have 2 people because, again, this entity is going to apply to FREC for a license. And just like spouses in real estate can't share a license, you can't have a second owner of the company or FREC will deny your application. This is another place where people, oh, well, I put my husband on so he can do banking. FREC doesn't care. So this is where you've got to be careful. And if you have a relationship with a lawyer or a CPA, that's fine, they can help you, but you need to make sure that they understand the FREC rules as well. When you're interviewing those people, you need to know, do they have other realtor clients? Because the FREC rules are completely separate and ignore the IRS rules and the state corporate law rules. They don't care. FREC says you can't have a DBA. You're certainly allowed under Florida law to have a DBA. FREC says no. So you've got to have somebody who understands the FREC rules on top of the IRS rules, on top of the state corporate rules.
And you would think that they would stop you and say, hey, you're doing this wrong.
No.
A million times. No, they want you to cut another $77 check and refile.
Yeah, absolutely.
Absolutely. So the difference between the corporation and the LLC, you get the same liability protection as the owner of the company. You want to insulate, it's called the corporate veil. You want to have a difference between the person who owns it and the company. If you have a car accident personally, you don't want them to be able to take business assets. And if you have a business issue, you're driving somebody around and you have liability, you don't want them to take your personal assets. That liability goes both ways. That liability insulation is identical between the LLC and the corporation. What's different is the corporation requires that you hold an annual meeting and keep minutes of those meetings. If you fail to keep minutes, that is something Morgan & Morgan, for the other people, are going to want to see. Like, hey, were you adhering to what they call the corporate formalities? Did you do what you were supposed to do as a corporation? Because if you want protected like a company, you need to act like a company, right? So you've got to have a separate tax ID number. We've got to have a separate bank account. Shocking news, you need to use that bank account. Deposit your commission checks into that business bank account. Pay your business expenses out of that business bank account. If you are using personal funds to pay business expenses or business funds to pay personal expenses, that concept is called commingling. Who cares? Morgan & Morgan. They're going to say, hey, what were you doing paying the nanny? What were you doing paying the mortgage out of the business tax return or checking account? What is the answer customarily? Well, that was the account that had money. So I made commission, and so I had money, and I needed to pay the mortgage. How else am I going to pay the mortgage? Transfer the funds from the business account to the personal account. That's called a distribution. Get the money over there to the personal account, then pay the mortgage. The vice versa is true. You're a brand new realtor. How are you going to get money in this business account to pay all these expenses? Because there's tons of expenses when you're new, while there's a big fat goose egg for revenue. How do you do that? You make a contribution. You take some personal money and you put it in the business account, track it so that it goes on the tax return, and you say, hey, here's $5,000 to get started, or whatever the number is. Now you can pay your business expenses out of the business account. You're not commingling. You're not jeopardizing your liability. Your bookkeeper isn't having a heart attack because they can actually see where your business expenses lie. Everything about this is better. You pay less tax, you have more liability, you sleep better at night. She's like, I'm not sleeping at all. She's like eating her fingers, like I'm so nervous.
It's better when you have it all organized properly.
Yeah, I promise. It's a lot at first. But once you have it all done, the day-to-day operations don't feel any different,
Right.
right?
Except for my like you.
Except for except for the judging about not.
It's fun. It's kind of like, yeah, when you're married, it's the best swipe right, swipe left you're gonna get.
Yeah, you're retired from that.
I did hold a class at the association a couple years ago.
Yep.
And you had like a 10-step process.
Yes.
For this. That's when I did it. I was like, I sat in the class, I was like, okay, I'm gonna go do this right now.
Perfect.
Is that the one you're doing at the Women's Council?
Yeah. And I give the 10 steps out because you can do it. Nothing I'm doing, I'm not curing cancer. But I always tell people, do all 10 steps and do them in order. Don't be select, because what happens is people get tired and they fall asleep at step 3 and they never pick back up. And that is worse. Doing some of the steps is worse than doing none of the steps.
Do you have that somewhere?
I do have it. I don't have it with me on my
You can
physical
email it,
person.
distribute it.
Yeah. But again, it's for sale by owner. Here's how to make your own listing. Good luck. It might be stressful. It might take longer. You know, it might cost more in the long. Sometimes what's cheaper isn't less expensive, but you are welcome to do it. Nothing that I'm doing is like unfathomable. The problem is it's unfamiliar. So you look at those documents, like when you go to Sunbiz, for example. Everybody been on Sunbiz? Sunbiz.org is our Division of Corporations website where all of the companies are listed. When you see that, it lists the name of the company, it lists the business address, and then there's a section for people. What kind of people? Who has to be there? Who shouldn't be there? There's a section for titles, and it gives you a few suggestions. One is MGRM, managing member. One is MGR, manager. One is MBR, member. How do you know which one to pick? Well, that's part of what we do. If you don't know and you just pick one randomly, is it a problem? It could be. I had one LLC that came in and the lady had put Mr. and Mrs. It's like, well, they weren't really looking for that. But, you know, if that's your designation inside the company, that's really not like an officer position or indicating any authority to make decisions or anything like that. But we'll fix that. So those kinds of things are where it looks easy, but there is method to the madness behind the scenes. And that's really what you need to make sure you have a handle on.
How much does it cost to sit down with you and set this whole thing up?
So if we set it up, we do everything on a flat fee. It is soup to nuts, everything you need to get out the door. So we will file your articles of organization with the Department of State, Division of Corporations. We will get your tax ID number. We will do your RE16 to move your license with FREC. We'll do your W-9 and confirm that your broker has moved it. We'll do your written consent to action to open your bank account. We'll do your operating agreement, which is really where your liability protection is. That's what fends off Morgan & Morgan. We will ensure whether or not you need a local business tax or occupational license. Those are not anything to do with your real estate license. It's just what kind of business are you operating. So for example, City of Sarasota, Sarasota County, both require. But Manatee County is only incorporated Manatee County. So if you're in Lakewood Ranch, you don't need one. How do you know if you're in Lakewood Ranch? Well, I don't know. Are you using the office? Are you using your house? All of those kinds of things go into that discussion. If we do it, it's a flat fee of $2,500. The only thing you will pay, the only thing you'll pay on top of that is the state charges $138 to file. You are required to file an annual report every year, no later than May 1st. That annual report is $138. Your occupational license, if you're required to have one, will also have a fee. My office is in downtown Sarasota. I've got to have a city and a county because I'm in both. So you need to be mindful of your location. Those are, we're talking $40, $50 kind of fees. They're not expensive. But the penalty for not having it when you're supposed to gets up there.
So $2,500 and we do nothing.
You do nothing, and it doesn't matter how much you call me. I don't have a Michael Phelps swimmer clock that spins and bills.
Tax deductible.
And it's tax deductible. Better yet. So it's even cheaper. It's by the time I'm done, it'll be free.
Is that going the other?
We'll owe you. Right. Exactly. Questions about anything that we've said so far? Happy, sad, confused, overwhelmed?
Overwhelmed.
All of the above. Once you are up and running, then we need to talk about, we have a new name. You got married. You say PLLC, right? Change your cards, signs, website, signature block. Do y'all use like a Form Simplicity or Transaction Desk?
We use Dotloop.
Got to change that in Dotloop because now the listing agent is no longer Jo Ann Koontz. The listing agent is now Jo Ann Koontz PLLC. I do not have a license as a person any longer. It is moved. So you don't want to be signing your listing agreements under the wrong realtor's name.
That makes sense.
Again, it's easy to go, well, it's just me. Don't say it's just me about anything, because that's what Morgan & Morgan wants to say. Well, it's just you. Why should I give you this veil of protection? I should be able to come through and pierce the corporate veil, because it's just you. So the more corporate decisions that you make where you go, oh, I don't need to have an operating agreement, it's just me. I don't need this, it's just me. I don't need a separate bank account, it's just me. You're making the argument for them. People do not appreciate the danger associated with that.
When you sign for the, let's say a listing agreement has for us to sign.
Yeah.
I sign my name. Do I have to put PLLC on the end of it?
You, not on the signature, but where it has it printed as who the listing agent is, yes. You, PLLC or LLC, as a representative of Next Home Excellence, but you are signing, like for me, I signed Jo Ann Koontz as an owner of Koontz & Associates PL. Mine is at least a different name, so it's easier to see. But when it's Jo Ann Koontz PLLC, people are like, well, which one do I sign? The name of the company can't sign its name. The company must have an authorized individual to sign on its behalf. So I would be Jo Ann Koontz signing on behalf of Jo Ann Koontz PLLC. Does that difference make sense?
And that's the same with the real estate contract as well. If there's things are in a trust, so you list it as, you know, Joe Smith as trustee of the trust dated yada yada yada.
Yep.
But then they can just sign it as Joe Smith.
Correct. In fact, there's new promulgations coming out suggesting some, especially older folks, like to sign Joe Smith, trustee. Title Insurance Underwriting is asking us to please have them stop doing that and just sign Joe Smith. Let us type trustee of the blah, blah, blah trust underneath it, but just sign, because they like to put trustee when they sign. I don't know, it must be something fancy when you get designated, I don't know.
Letters behind your name.
Right. Thank you so much for having me. If you have questions, let me know.
All right. Thanks. So we're gonna post this out, and thank you so much for your time. You
My
are
pleasure.
like the best presenter. We
Well,
love
thank you.
having you, and you promised me you're gonna come back.
I
We'll talk
promise I
more
come
about
back. No one
business
died.
formation.
No one died.
Not this time.
No one died of
Should've said
boredom.
Our last one.
No one died of boredom. Maybe they fear. There might be a heart attack or two.
All right. Well, thank you very much.
Thank
I really
you.
appreciate it.
Thanks so
for
much.
coming in.
Thank you.